2023 is not going to be my record year in terms of production, but it is the year I've probably had most growth as a real estate professional. I've had to really learn economics, really study the market. I have had to pivot more than I ever have in my career because of all of the changes, whether it's policy-wise with guidelines or it's a historically high rate increase. I mean, there are so many things that I've had to adapt with this year in real estate, and this last week was no exception. For starters, we had that huge decision with the lawsuit against the National Association of Real Estate Agents. Then there was the Fed's decision not to raise interest rates, and the unemployment numbers and what this now means for the potential recession. I mean, all of these three things alone are going to have a huge impact in people's decision to buy or sell, but it's crazy that all three of these things happened in literally just 1 week in 2023. So I want to unpack all of that stuff. And I also just want to say thank you guys, because this is the month of gratitude for all of your support with this channel and my business and just rooting me on as a human being as I rebuild my life. It's meant a lot to me. So I want to break down the first item, which is that NAR lawsuit. I'm not a lawyer and I'm definitely not a legal professional, but from my interpretation of what happened, there was a lawsuit against many national brokerages, including the National Association of Realtors. And the lawsuit was that, real estate agents had colluded as a profession to enforce 3% commissions, and that buyer agents were unfairly compensated through the listings of people's homes, so the sales of people's homes. As somebody who's worked in real estate for 20 years, this is the way it has always been done. So I don't know a different type of market. I know that certain economies, buyer agent commissions will be paid for by the buyers, or you'll see a reduced commission, and other markets I've seen increased commissions. It really honestly just kind of depends on supply and demand and whether it's a buyer's market or a seller's market. This market is very unique, and it's an interesting time for them to start pursuing this because people that are buying in this market are already having a really tough time affording closing costs and down payment costs and repair costs and discount point costs. And so adding an additional cost to the buying process now seems counterintuitive to an insanely slow real estate market. And if you were a seller, I don't know that it makes, if it's in your best interest not to pay a buyer's agent in this marketplace, because again, you're going to be adding an additional hurdle to selling your property. This is not true for every economy, not true for every market, but it is something that you want to consider. One thing that I thought was interesting is that people were like, well, why should sellers have to pay for this? And I do just want to caveat that it's included in the purchase price, and the buyer is paying a down payment and closing costs based on that purchase price. And the purchase price is intended to cover their buyer agent commissions. Yes, it does come from the seller's proceeds, but it also is paid for by what the buyer is willing to pay for the property. I don't think it's as slanted as the headlines would lead you to believe. There's a lot of legislation still to be done on the topic. NAR put out a statement saying it's business as usual, and they are going to appeal this decision, as well as some of the brokerages. I think that this is a long legal battle. As of today, I think it's still business as normal in most markets and most industries. And so if you are selling your property, I would still expect to pay a buyer agent commissions. But I do think that people are going to start questioning fees more and more and more. And I think real estate professionals are going to have to really prove their value if they're going to want to charge premium prices. So one of the other things to consider outside of the Fed's decision not to raise interest rate, it's what's happening economically, because we had lower earnings and we had a very weak jobs report that came out last week. And the reason I'm bringing this up is, one, it had an impact in improving rates, but two, it says a lot about what's to come for the economy. In fact, you will see that there are recession headlines all over the place, and people are really worried about how strong the economy really is. One of the reasons the job report was really alarming is that new job creations for this time of year, typically we see a bump up because of seasonal jobs due to the holidays, and having it not come in at expectations was kind of alarming. Not to mention we saw a bump up in unemployment, and when you really break down the numbers, the average weekly work week dropped by a half an hour, and the number of people who have to have multiple jobs, right, to make ends meet rose by over 200,000. What this is really saying is that people are, the average hours was 35, which is not close to 40, or 38, which is what people consider to be full-time employment. So that's dramatically under. And people are just not making the overtime or bonuses or the consistent hours, so they're having to take on second jobs, which, if you're thinking about second jobs and all the new job creations for the last like several months, it paints a different picture of what the actual employment numbers really were for the previous months. The one other thing I do want to mention, and this is something I hadn't actually considered, was that every single month the jobs number has been corrected. I knew that it was being corrected, but I didn't know what it was being adjusted for. It's being adjusted for the number of jobs that have to be refilled because people die. When you think about like that, we've been gauging what to do with monetary policy on a report that has to be adjusted and is not in real time and isn't being adjusted for multiple job holders. It makes me scared that the Fed really missed the boat in lowering interest rates much sooner. Now, why is this important to you? Well, if you're somebody who's wanting to purchase a home, you're going to want to pay attention to headlines that deal with inflation and deal with employment, right? If inflation is going high, that means the rising cost of goods and services, expect interest rates to go up. If we see strong employment numbers, expect interest rates to go up. If we see the opposite, expect interest rates to go down. The market is still really volatile because mortgage-backed securities are an investment vehicle, and in order to have stability in that market, you have to have a stable long-term trajectory for what that investment will perform. And unfortunately, because there's a lot of data pointing to, rates going down lower and a large refinance boom in the future, there is very little appetite for investors and mortgage-backed securities. So we are going to see a volatile market until that stabilizes, which is probably a recession and our federal government buying mortgage-backed securities to stabilize real estate. We'll pay attention, and I will keep updating you on that, but just know you want to pay attention to that. Now, if you are a homeowner now, here's something I will say. Some of you are going to have to sell your properties to pay down debt to get ahead and regain financial stability. I know that sounds really awful. Just to be candid, when I sold my property in my divorce, I paid down my debt and I downsized so that I could safely afford the economy that we're in now. I had no idea that it was going to be this slow, and I'm so grateful that I did that a year ago. Other people will have to do cash out refinances, and I know that probably sounds bonkers, give up a 4% rate for a 7% rate, but there are a lot of people, guys, with double-digit credit card debt, a high auto loan in the 8 or 9%, student loans, and when you factor in your mortgage, your auto debt, your credit card debt, your student loan debt, your blended credit rate is probably closer to 7 to 8% than most people think. And the additional cash flow that you would allow for yourself by paying off those debts is impactful. And so that might make a ton of sense for people in that right financial picture. And if you are also looking to move up, you might want to consider these same strategies, on the other side. I had a borrower recently who had $200,000 of equity, $50,000 worth of debt, paying off all of the debt and buying a house that was upgraded in a larger price point with less money down actually was $200 cheaper than putting all of the money down. I'm going to be doing a video just breaking that down, so definitely pay attention to that. But those are all things that are going to be impacted if you are a property owner or thinking of buying a property this next year. Let me know what questions you guys have. Put them in the comments below. I'd love to do a live Q&A, so let me know if you'd like that. And if this video is helpful, guys, don't forget to like, comment, and subscribe and share it with a friend. And thank you guys again for all of your referrals. Your support with my business means the world.